Hi everyone, it's Chat About with another video. Today I'm going to do a stock analysis of a company that recently released earnings, JPMorgan Chase. As the biggest US bank by market cap, its earnings carry a weight unlike many other companies, and of course, CEO Jamie Dimon is a voice that many listen to and is one of the most well-respected and successful CEOs in the game. Earnings actually disappointed expectations in contrast to Bank of America's, which were much better, and the stock took a hit, continuing a bad year now, down nearly 20% since January the 1st. Or analyse this company, do a DCF, look at the balance sheet, figure out if I think it's undervalued or not, and then go through what went wrong with this quarter. Up first, taking a look at some balance sheet metrics, some profitability metrics from Guru Focus. Lots of similarities to be drawn to Bank of America that were released the other day, and I covered that in a separate video. Cash to debt ratio is pretty good here, better than Bank of America and good for a big bank. Very good historical rating. Cash to debt 1.52 for one of the big banks is pretty decent. Although versus the industry, it doesn't really show that. This is an excellent number for JPMorgan's history. Equity to asset predictably low, over $3 trillion in assets, so 0.07 equity to asset is entirely predictable here. Debt to EBITDA ratio of 4.12 shows debt is well covered by profits and easily serviceable. JPMorgan has an excellent balance sheet, fortress-like, no cause for concern, and is actually a very big strength of the company despite what Guru Focus says. Jamie Dimon is about as good as CEOs get and is an excellent capital allocator, so I have complete faith in him in this department. Net margin of 35% on the profitability side, very, very close to Bank of America, is pretty standard actually for one of these big banks, but very, very strong for any industry. Even if it looks pretty normal for this industry, 35% net margin is absolutely fantastic. 35%, a very dollar of revenue into the back pocket. Return on equity percentage of 14.09% is again very, very good for a bank. Not so good versus the wider stock market. I would say between 10 and 20% is what I would expect for a company of this size and scale. 14% kind of in the middle, but in banking this is pretty good in my opinion. And of course better than Bank of America. Return on assets predictably low at 1.12. They have a massive asset base. It's literally the opposite of an asset-light business. So predictably low 1.12 return on assets percentage, where I would normally expect 5 to 15% for a company of this size. That 1.12% is okay for a company in this industry. Overall, excellent profitability and a fortress-like balance sheet. Not a lot to dislike here. Like Bank of America in my last video, and I'm going to keep making this comparison because it's so apt, price to earnings here looks very cheap, below 10, which is far below the S&P 500 average right now, which is around 20. Typically in normal times when the S&P 500 is around 15, 16, 17, US banks trade in the range of 8 to 15. JPM usually commands the higher end of this being the premium name. I think 10 is a completely reasonable PE for JPM based on the historical numbers. A PEG ratio of 1.45, it's getting towards bargain territory really, of under 1. I consider 1 to 2 to be an absolutely investable range, but not dirt cheap, very low for this business of course. And that's compared to Bank of America's 2.1, so there's clearly earnings growth expectations for JPMorgan are much significantly higher. Price to free cash flow, just 4.94 is incredibly low, very, very low. The most relevant in my opinion for banks and how they're often valued is price to book value. It's actually pretty expensive here when compared to the other peers. Not outrageous by any means, but 1.52 price to book. Looking at Bank of America at 1.3, this is actually a pretty big premium compared to that, even though they trade at very similar price to earnings ratios. So overall, clearly far below that of the market, trading far below its historical valuations, and it's a P of around 9, 10, where it traditionally trades at between 13 and 15. I think that is on a price to earnings ratio basis, this is a decent buy-in point. On a price to book value basis, it's a little more expensive, but not ridiculous. Next on the list, of course, is to do a discounted cash flow analysis to work out the value of this business based on the sum of its future cash flows. Actually very difficult to do it because free cash flow data is kind of all over the place, so I'm going with earnings, so use that caveat going forward. I'm really making a conservative estimation for EPS here because I don't think it's going to grow at 17.8%, which is the 5-year average for the next 10 years or so. And I don't think it's going to grow at 11.7%, although that is far more possible. It's definitely not going to grow at 73%, which is the most recent average. On average, book values increased between 6 to 7% over the last 10 years, and revenue has increased 5.4% over the last 10 years. In my opinion, a conservative estimate for EPS is one that follows this, rising 5% on average over the next 10 years, With a discount rate of 9% and a terminal stage of 4%, this gives a fair value of $182 versus a present day stock price of $131. Clearly undervalued based on this intrinsic valuation calculation, even with relatively conservative estimates. Using a reverse DCF, the required growth rate for fair value is just 0.2%. Effectively, no growth in earnings is fair value here. Clearly, this is some market inefficiency, and this company is being undervalued on an earnings per share basis. Digging into the most recent quarter one results, at a high level, these results are not overly impressive, and I can see why the stock price dropped. Revenue down 1.5% year over year, significant decrease in return on equity from 23% in Q1 2021 to 13% now. Net income also down significantly. All pretty disappointing, especially when compared to other peers such as Bank of America again, which did quite well. This is not a good sign, and I think we need to dig a bit deeper to figure out what the cause is. I'm not going to go through every business segment in detail, just the two key laggers. The first one being consumer and community banking. Net income of $2.9 billion versus $6.8 billion in Q1 2021. Significant decrease year over year, and revenue down 2% year over year. Expenses up 7% year over year, driven by higher investments, structural expense, and partially offset by lower volume and revenue related costs. You can see from the revenue basis, consumer and business banking was up slightly year over year, but home lending really took a big hit, and card and auto also took quite a big hit. All in all, quite a big decline in net income, and that is part of the reason why there's such a disappointment on the stock price. Second segment that disappointed was the corporate investment bank segment. Net income of $4.4 billion, down 26% year over year. Revenue of $13.5 billion, down 7% year over year. Now, I'm not going to deem them too much compared to the consumer and community banking, which was kind of worrying. This is not so bad because investment banking is known to vary widely. Goldman Sachs just put up an absolute stinker of a report, and so I'm not going to deem them so much. Investment banking revenue was down quite significantly from year over year, and that's basically due to bringing in less fees, less companies want to do IPOs, things like that. Payments was up quite significantly, and lending was up a little bit. Total banking was down slightly year over year, but again, I'm not going to ding them too much because it's a very variable segment. But in combination with the community banking and consumer banking being down, this is not good. Overall, this is clearly an excellent business that produced an uncharacteristic weak quarter. Lots of challenges in the wider economy. Pretty hard to see if there's a wider problem here. It does not seem to be the case. Investment banking revenue is highly variable, as we've seen with Goldman's terrifically bad results, and also there's lots of challenges in the consumer segment, as consumer sentiment is all over the place at the minute. There's a war going on in the world. There's all sorts of supply chain issues. I'm not going to deem them too much for revenue being okay and net income being down. I don't think that's the end of the world. It's a cheap stock, which means they have high margin of safety here. So I think that margin of safety is enough to get over a weak quarter and an inherent increase in risk here. It's a premier name and a premier performer over the long term. Excellent management, and just about as good as management as you can get in my opinion. Buys back a ton of stock and pays a nice 3% dividend that is well covered. It should be able to grow at low single digits, mid single digits for forever in my opinion. Margin safety is really nice here, and for me this is a decent entry point. Of course, I'm still analysing other banks, and I definitely think the recent performance, particularly this quarter, is weaker than Bank of America's, with almost equivalent in everything else. So if you ask me to choose one right now, I'll be picking Bank of America, but over the longer term I trust JPMorgan to do just as well, if not better. Of course, none of this is financial advice. You should not take it as such, and you should do your own research and due diligence before buying any stocks. So let me know what you think of JPMorgan Chase. Do you think it's a good investment? Do you think Bank of America is a much better investment? Do you think Citi's a better investment? Goldman, blah, blah, blah. Let me know whatever you're feeling. Of course, like and subscribe to help the channel grow. I'll see you again next time.